Hey everyone, in today's video, we're going to be talking about the top 20 Canadian stocks to consider buying. I'm not going to go into too much depth on each of these names because we'll be here forever, but hopefully you guys take away two or three Canadian dividend stocks that you take away to look a bit more into to consider adding to your portfolio or adding to your watch list. Or maybe you learn a bit more about one or two of these stocks on the Canadian stock exchanges that you didn't know existed prior or you weren't interested in prior. And it can just give you some ideas of what stocks to add to your portfolio moving forward. So if you like this type of content, be sure to give this video a big thumbs up. I still have a pretty small channel here, so it really does help a lot with the YouTube algorithm. And with that, we're going to jump right into things. The first stock I'm going to talk about today that is a big Canadian company paying a really nice dividend is Manulife. Manulife Financial is primarily an insurance company. They operate in Canada. They also operate in different geographies across Asia. And they also do a lot of wealth management as well. If you look at their current dividend yield, they're paying out over 5.5%. They have a trailing price to earnings of 9. So this stock has really had their PE go down over time. Looking at the company over the past 5 years, it's pretty much gone nowhere. I think this stock used to trade at a PE closer to the mid-teens. So it looks like their PE has greatly diminished. Looking at what their current PE is, they're expected to do about $3.20 a share this year in earnings. So if you look at that versus their $26 share price, they're kind of trading at about an 8 times earnings. And then next year, they're expected to do about $3.50, which gets them closer to 7 times earnings. So this stock is trading at bargain basement prices like lots of the other financial stocks are. But it's definitely an interesting opportunity here, especially when you're getting an automatic yield of over 5.5% as a starter. And they've also increased their dividend over time as well. So this is a really enticing option in the financial space if you want to complement a big bank position, or if you just want to diversify away from banks within your financial exposure in your portfolio. The second stock on my list is Rogers. Rogers Communication is a big telecom company here in Canada. They actually just acquired Shaw Communication. If you're familiar with that brand name out west, it's now owned by Rogers. The stock's paying a 3.5% dividend, and I actually have the US chart up, so I'm going to pivot to the Canadian one here. But the stock is paying a 3.5% dividend, has a market cap just over $30 billion, so really big company. Rogers, I believe, is the number one wireless company in Canada in terms of data plans and stuff like that. So they have a huge business on getting a chunk of your cell phone bill. They also beefed up their cable exposure. Some may like that, some may not like that, given some of the more global trends on cable. And then lastly, they have a pretty big media division. They own the Toronto Blue Jays outright. They also own about 40% of Maple Leaf Sports Entertainment, which owns the Raptors, owns the Leafs, owns Toronto Football Club. So that's ingrained in their valuation a bit, but it's nice to know that you own a piece of those really valuable assets when you own stock of Rogers. Looking at their PE here, expected to do $4.30 this year. So that's about 15, 16 times multiple. Next year, though, if this comes true, analysts are expecting them to cross $5 VPS, which would get them closer to 11, 12 times earnings. So it really depends how well they incorporate the Shaw assets, and it's kind of just the macroeconomic trends on immigration into Canada is a big driver of their business, as well as pricing and the integration of people getting more data in their plans versus the offset risk of people potentially canceling more and more cable. So that's the second Canadian dividend stock, pretty reliable dividend payer over the last 10, 20 years. The third stock I'm talking about today is Canadian Natural Resources. So this is an oil and gas company, price to earnings of 12. They're a $90 billion company, excuse me. So huge company here, pays a 4.4% dividend yield. Looking at their EPS, current year EPS at $6.70, expecting huge growth next year of to $8.20. So that's like 30% earnings growth, which gets them to about a 10 times future earnings PE. So we'll see how much of this actualizes, if they're actually able to do $8. Some analysts have them up to $10 plus, which would have this stock at an 8 PE in 2024. So all depends on how bullish you are on the company and the oil and gas sector. But currently, definitely one of the safer plays in that space, it appears, just from the size of the company and the scale and diversity of their asset class. And you're getting paid a nice 4+% yield to sit on the company. The next stock that we have here is Metro. So Metro is a grocery chain. They primarily operate in Quebec, but they also have presence in Ontario and some other areas of the country, I believe. They own Jean Coutu, which is a drug banner in Quebec, which is a decent size of their business. I believe they acquired that a number of years ago for $4 or $5 billion, so about a third of the company. Company trades at a 19 price to earnings, has a 1.7% dividend yield, but they tend to increase their dividend over time. Just looking at the last 5 years, you can see how well this company's done in terms of just creating value year over year, pretty up into the right chart, from $40 a share up to $70 a share here, not including the dividends they've paid out. Looking at their earnings estimates, they're at about $4.30 this year, expecting 5-6% growth to $4.60 next year. At $4.30, this company's trading at a mid-teens multiple, which I think is fair for, a grocery chain. It's a tough business, not a ton of growth historically. I know they've been growing a lot the last few years, but I think that's probably a fair valuation. They don't pay a huge dividend because they retain lots of those earnings and invest in their business. Lots of people are doing more online ordering, so they have to invest in those capabilities, some other threats and things that they have to make sure they're defending the business a bit on. So I think this dividend's fair and comparable to their competitors. The next stock we're talking about for Canadian dividend stocks to consider buying is Pembina Pipeline. So this is a high dividend payer, 6.4%. Looking at the stock in the last year, it's down 12%. So it's on some weakness here if you like buying stocks that are closer to their 52-week lows. This is a pipeline company, if you can tell by the name. They own pipeline assets in Canada. They get paid to move around oil and other things for the most part. So they don't actually own the assets that's creating energy or oil, but they are facilitating the movement of it between provinces and stuff like that. Looking at their earnings per share, they're right around $3, a bit lower. So at $3 for next year, that would put them at about 14 times earnings. With companies like this, it really matters more about the free cash flow, as that's what they're using to pay the dividend, more so than what the accounting EPS is for the company. If there's a big capital expenditure one year or something like that, it may have an impact on the year-to-year EPS. So I feel like these numbers may be a bit understated given how high of a dividend they pay, but generally their ability to pay a 6.4% yield speaks to the free cash flow that they have coming through the company. So this is a good option if you want a relatively reliable payer. They've been paying a dividend that's actually slowly increased over the last decade, and it's a pretty high starting yield. So if that's interesting you in a pipeline type company, Canadian stock obviously, Pembina may be one to put on your short list. Okay, Canadian Tire Corporation. So Canadian Tire Corp is the next company we're talking about half the size of Metro and a very big, very different business than Metro. They are entirely franchised, so they have lots of store owners that they get royalties and licensing fees from, whereas I believe Metro owns the majority of their network other than Jean Coutu, which is also franchised, I believe. Canadian Tire trades at a bit of a lower price to earnings here, 11 times, because they have more discretionary products. They're not as grocery and staple focused in terms of the mix of the products that they sell. But with that, you get a bit of a nicer dividend. They're paying out about a 4% yield here. Looking at their earnings per share estimates, they're expecting to do $15 plus in the current year, $18 in the next year. So they're trading about 11 times current year and about 9 times next year's earnings. So pretty attractive valuation for this company if they're actually able to deliver these earnings estimates. And I guess it's just coming with higher risk that if the economy does go into a recession or something like that, Canadian Tire may be at higher risk of being impacted in a great way on their revenues and their earnings. And that's why the market's giving them a bit of a discount on the multiple. But with that being said, if you believe this company will get through it fine and maybe there was not as much macroeconomic pressure as the stock's trading into, then it could be a good opportunity to get in at around a 10 price to earnings ratio, get that 4% dividend yield off the bat. So that's another option for some of you to maybe do some more research and add to your watch list if you're interested in evaluating a retail stock to add to your portfolio. The next stock is Labrador Iron Ore Royalty Corp. So this is a stock that's been on my watch list before. They operate in the east of Canada. They produce, or this company more broadly is a joint venture with another company, but they essentially produce iron ore for all over the world. Iron ore is used in a lot of development projects and stuff like that. So as the economy is doing well, if there's lots of infrastructure spending, stuff like that, there's a lot of demand for iron ore. China and building in China is one of the main customers of iron ore. And this company was just set up as a royalty corp for the underlying company. So they essentially own 15% of the mine in total. But then they also get money from every ton of iron ore that gets shipped off. They get a royalty off the top of the purchase price that comes into this company, gets paid out as a dividend. So current trailing 12-month yield is about 8.6%. They have a lot of free cash flow since it's just a royalty corp. So they're not really required to have a lot of CapEx spend in this company or the human salaries, stuff like that. Pretty much all those royalties from all the iron ore that's leaving the company is just going straight into the quarterly dividend. The dividend yield has fluctuated depending on the year. In some years, it's been 15, 20%. In other years, it's been 5, 6%. So right now, trailing at about 9%. But it's really no way to see where it's coming. This is not the stock for reliable income necessarily. If that's what you're looking for, as the stock's all over the place, as you can see in the last 5 years, very commoditized, and also the dividend yield will follow that as well. Both as the stock goes up, tends to mean iron ore prices are high, tends to mean you're going to get a higher yield on cost because the dividend payouts will be higher. So looking at what analysts are expecting for iron ore here, they're expecting about a 10% return, right around $3 of earnings per share this year, next year. Most of that will come back in a dividend. So once again, a riskier one on the list, but the potential to have pretty high dividend payments and cash flow from this stock. And if you've held this stock for a long time, you can see the 5-year here. It's actually done pretty well over the long term, but it's nothing to say that this can go the other way in the next 5 years. Because in the last 5 years, you've gotten a 22% return. You've also probably averaged about a 10% dividend a year. So you've probably got about 70% return overall in the last 5 years. Going into the next stock. The next stock is Smarcentres REIT. So Smarcentres REIT is a retail REIT operating in Canada, the large cities in Canada. They own some shopping malls, but they're also buying more and more like downtown properties and higher quality assets as shopping malls become less and less attractive, both from debtors and consumers here. So they're trading at $25 a share. Their current dividend is, I don't see it here, but I believe, oh, there it is. It's about 7%. So you're getting a really healthy dividend off the bat. Prices and some of the risk associated with owning retail real estate and some of the shopping mall assets they may have. Looking at their funds from operation estimate, they're at $2.15. So $2.15. This company is trading at about 12 times their funds from operations. So yielding about 8.5% returns annually, and they're paying out 7 to 7.5% of that to investors. With the rest, they're probably investing, paying off debt, whatever it may be. But you're getting a pretty decent multiple at low teens for pretty good assets overall. I know people paint all of retail assets the same way, but these big REITs tend to own some of the best in terms of the location, the size, the tenants that they have. Smarcentres specifically has Walmart as their key tenant for a lot of their shopping centers. So they tend to, maybe have to give up some favorable terms in order to hold Walmart, but tends to be a pretty safe tenant to have paying you every month, given just the size of that company and the defensiveness of it as well. So just another option for you there if you're looking for some REIT exposure with a high monthly dividend yield. Going into the next stock, Alimentation Couche. So this is a stock that has done really well over the long term. I'm going to back out a bit here. Over the last 5 years, up 120%, trades at about 17 times multiple, $67 billion company. Even though this is a Canadian company originally from Montreal, they really have a global footprint. They operate in Europe. They operate, I believe, in Asia as well. They have a huge presence in the US and obviously across Canada. They own the Circle K brand. They used to own the Max convenience brand. So they are the world leaders in convenience stores. With that, they also own lots of gas stations. And there's been some talking that has kind of slowed down in the recent run-up, but some concern on their ability to turn their gas stations into EV charging stations as more people move towards electric vehicles. It seems like the sentiment around that slowed down, and the investment cycle on that may be more drawn out than people initially thought a couple years ago. So we're really seeing the stock rally behind strong earnings. They also acquire a lot of different companies. They're a growth by acquisition company, but you've seen it on a per share basis. It's been really accretive, and they've driven a lot of synergies and scale. Looking at their EPS, they're going to do about $4 this year. So trading at about 17 times current year earnings, 16 times next year earnings. So not necessarily a cheap stock, but within the retail space, they really have a unique niche that they solve, and they also give you some geographic diversification as well, if that's something that you are interested in. Okay, going to the next stock, CN Rail. CN Rail is probably my favorite stock that I own. I've owned it for a very long time. You can see since they went public, they've had amazing investor returns. Even the last 5 years, up 7% CAGR per year, also paying out about a 2% dividend consistently throughout that. They also increased their dividend year over year. So even though it's a 2% starting yield, that'll go up every single year as they increase those dividends. CN Rail trades at a more expensive multiple than some of the companies we've talked because they do have a really strong moat. People aren't really building new railways nowadays, and there's really no way for lots of their customers to move their product to end consumers without CN Rail's tracks. So looking at their earnings estimate, about $7.50, so trading at about 21 times current earnings, and then closer to 18 to 19 times 24 earnings, assuming estimates are accurate. So I think CN Rail around 20 times is a fair valuation, in my opinion. I do hold a lot of this one, so I may be a bit biased, but it's one that I always have on my watch list for whenever it gets a bit of a dip. You've seen in the last year as the economy slowed down a bit, the rails have also followed. CN Rail down about 3.5% over the last year, but I'm holding this one for the long term, so I'm not too concerned about that. Going into the next stock here, Savaria. Savaria is a mobility company for older individuals. It's a Canadian company operating out of Montreal, but they also have acquired some stair lift and other types of companies in Europe and in the US and such. So they do have a bit of a global footprint. They own a manufacturing plant in Mexico and China as well, but they do a lot of in-house residential elevators, things for older people to be able to get up and down the stairs easier, as well as fitting vehicles to be wheelchair accessible. They sell adjacencies like canes, hospital beds, like stuff like that, for people to be able to stay in their homes longer with old age. This is a bit of a demographic play, as more of the world and more of Canadians and people in North America more broadly have that baby boomer generation getting older and aging and needing more of these services and products. That should hopefully provide a lot of organic growth to this company. It's been about flat over the last year, but year to date up about 17%. You're getting about a 3.2% dividend yield. Looking at their earnings per share, they had a bit of a weaker year this year. I believe they had a lot of investment in opening the Mexico plant and some other inflationary margin pressures. So 65 cents a share this year, trading about 25 times earnings or something, I believe that is. Next year at 91 cents, if they're able to pull that off, that'll be about an 18 times PE, which is probably a bit more reasonable for the company. So if they're actually able to ride that growth trend of baby boomers aging and needing more of these products, people wanting to be in their homes for longer, this could be an interesting long-term play on the stock here. Going into the next stock, we talked about Canadian Tire as a business earlier. Canadian Tire also had a real estate portfolio that they spun off. It now trades under CT REIT, CRT.UN. The stock pays a 5.8% dividend yield. They own lots of the underlying real estate that Canadian Tire locations are doing business in, but they also own other types of properties, adjacent properties to Canadian Tires, and just completely different types of properties as well, even though the majority of their earnings come from the Canadian Tire Corporation. Looking at their multiple here, they are expected to do about $1.20 in funds from operations. You see here they did 60 cents in the first 6 months of the year, and that was actually pretty good growth for a retail REIT in this environment with interest rates going up. They grew funds from operations about 7% per share. So at $1.20, this company's trading at about a 13 times, give or take, 13 times funds from operation multiple, which, given the fact that they've actually been able to grow their FFO at that mid to high single digits for the last couple of years, and I think they just recently increased their dividend in this environment, is probably a fair multiple. You saw Smarcentres at about 12 times, so they're trading at a slight premium to that. But overall, I think both of these, or all of these REIT stocks are trading at below net asset value and at long-term decent entry points, in my opinion. The next stock that I am talking about today is Royal Bank of Canada. So all of the Canadian banks kind of fall into the same sphere here. Some of them are different levels of quality, focus on different things. Royal Bank of Canada specifically is the largest bank in Canada from a market cap standpoint. They also have a very large capital markets division. Tends to be more volatile in good times or times that there's lots of trading activity going on. They make a lot of money from that division, but it's not necessarily consistent. They're trading at a 12.5 times PE, over 4% starting yield. Looking at their outlook for next year, expected to do about $12, so trading closer to 10.5 times next year's earnings if they actually grow at that pace. Another bank that I had on the list here back to back is Scotia Bank, Bank of Nova Scotia. This stock is not priced as nicely from a PE standpoint versus Royal Bank. So I believe Royal Bank right now is the highest PE trailing, and Bank of Nova Scotia is the cheapest, currently trading at a 6.6% dividend yield for starting investors here. Their trailing P is at 9.5, but they're actually expected to do closer to, I got another US one here, but I believe they're planning on doing enough EPS to get them closer to 8 times forward earnings. So 8 times forward earnings for a big bank that has paid consistent dividends and increased their dividends for 50 odd years seems like a great entry point in my opinion. I've actually been buying more of Scotiabank, and I do have it in my portfolio. Looking at the stock here, so $7.60. So between 8 and 9 times next year's earnings is where Scotiabank's trading. That means they're yielding about 12% returns on their current equity. And if I look at how much they're paying out, they're essentially giving you half of it off the bat, and then the other half, hopefully, they're reducing debt, buying back shares, investing in growth opportunities, acquiring companies. So they're hopefully pretty cash rich with that $8 of EPS they're expecting next year, and they can do really good things to create strong long-term shareholder value for their investors. The next Canadian dividend stock is Restaurant Brands International. This is another stock that I actually do own as well. Looking at the stock over the last year, it's up pretty nicely, up 28% in the last year, 12% year to date. This company owns brands like Burger King, Tim Hortons, Popeyes, and recently acquired Firehouse Subs. And they have been growing really nicely coming out of the pandemic. Especially Tim Hortons has had a couple years of double-digit growth, getting back to where they were before the pandemic. Looking at this company from a EPS standpoint, expected to do about $4.30 this year. So if I just multiply that out, trading at about a 23 times earnings, give or take, and then going to go closer to $4.70 next year, which gets them down to about a 22, 21 times earnings for next year at $98 a share. So I really like how they're focusing on global expansion and not really opening up their own restaurants, but franchising out restaurants, very asset-light model, similar to like what McDonald's is doing, what Yum Brands does, et cetera, et cetera. So they have a lot of growth opportunities, specifically on Popeyes, which they acquired, and also they're trying to expand Tim Hortons a lot globally as well. So we'll see how those endeavors go. The next stock I have up is Empire Company. So Empire, similar to Metro, is a grocery chain. They own Sobeys, most notably. They also own Freshco, I believe, under Sobeys. They own Farm Boy, which they acquired. They bought 50% of Longo's, which is for those of you watching from Ontario probably know Longo's. And I believe they also bought Safeway out west as well. So they own a bunch of different banners. On top of that, they own a lot of real estate. I believe it's a REIT called Crombie that they own about 50 or 60% of this REIT here, which has a $1.5 billion valuation. That was a spinoff of their real estate arm, which they kept a lot of the equity of, so they get paid dividends into the parent company from that. Currently paying a 2% dividend, trading at 14 times trailing earnings. Looking at forward earnings for current year is supposed to be about $3, so trading about 12 times that. And if they're actually able to pull off this 10% growth, they're trading closer to 11 times forward earnings on this stock. So trading cheaper than Metro, that's for sure. That stock was trading at about 15, 16 times, but not as cheap as Canadian Tire, which was at about 10 times. Going into the next stock here, it is Telus. So Telus is a telecommunication company, but they also have a big health division as well that they've been investing heavily in. The stock's been down 20% over the last year, paying a 6% dividend yield. So really juicy dividend yield on this one here. Looking at their earnings per share estimate, it's right around $1, and then it's going up to $1.20 next year. So at $1.20, the stock's trading at about 20 times earnings. At $1, it's trading about 24 times earnings. So a bit expensive. Truth be told, I don't know too much background on this company in terms of if their free cash flow is significantly better than their EPS or if there's any one-time items. I feel like their free cash flow must be outpacing their current year EPS if they're actually paying a 6% dividend yield. Because to pay a 6% dividend yield, if your free cash flow is the same as your EPS, you need to be at a PE of about 15, 16 times to generate enough cash to pay that out. And I highly doubt a big historical company like Telus is paying significantly more money year in, year out than they're taking in. So this one I need to do a bit more research on. It's not one that I currently own because I do own Rogers, which I started off with, but they do have a big health division of their company, which once again is riding that wave of people needing more of those services as they are getting older and as the population increases. So could be an interesting one to evaluate more, one that I should probably put on my watch list to better understand as well. Okay, getting down to the last two stocks here. Second last stock number 19 is Boardwalk REIT. Boardwalk REIT is a residential REIT. They primarily operate in, I believe, like the lower income tier of apartments. Lots of their assets have deals with provinces and governments to cover part of the rent, but they also have different styles of assets as well, where it's more mid-tier apartments and stuff like that, but they don't play too much in the luxury space. Looking at their funds from operation, expected to be between 330 and 350 is what they quoted, and the current stock is at $65. So at 350, the stock's trading at about 18, 19 times, which is a bit cheaper than some of the other residential REITs. Cap REIT trades, I believe, at 21, 22 times. So in the same ballpark, but a bit less just because of the quality of the assets potentially. So that is the residential REIT that I included on this list. And the last stock of the top 20 Canadian dividend stocks to consider adding to your watch list or buying is Power Corporation of Canada. This is a financial company. They're in so many different areas. Just going down here to read a bit more about them. They operate in North America, Europe, Asia. They provide services from insurance to retirement to wealth management to investment management. I believe they also own a good chunk of Wealthsimple, which is actually one of the brokerages that I use. So they're looking at different ways to monetize that asset. I know they've sold some equity in the past of Wealthsimple to groups of investors. This one has a market cap of $23 billion, so significantly lower than some of the big banks or big insurance companies. And they've done pretty well over the last 5 years, up 30%. They pay a nice, juicy 5.4% dividend yield. And looking at their earnings per share, expected to do about $3.60 this year, $4.20 next year. So they're trading just over 10 times price to earnings for current year and just under 10 times price to earnings for next year. So really in line with kind of like where the big banks trade for the most part. Okay, so those were the 20 Canadian dividend stocks that I had on the list. I hope you guys enjoyed this type of content and maybe picked one or two stocks out of here that you're gonna go back, do some research on, or maybe you already own some of these stocks. Would love to hear from you in the comments if that's the case. And if you made it to the end of the video, thank you guys so much for watching. Not too many people make it to the end, so I really do appreciate it. Let me know in the comments as well. Just say hello. Would love to meet more of you guys. Drop a big like on this video. It does a ton for the YouTube algorithm, and I will see you guys in the next one.